Our next reading is Security Market Indices. First, a quick overview, and then we will do questions from your curriculum, EOCs, and then from the question bank. So these are the specific learning outcome statements, and we will try to briefly cover all the contents of these LOSs. And this is specifically to be focused upon. These are the key areas to cover. What students are expected to understand: the construction, calculation, and weaknesses of price-weighted, market capitalization-weighted, and equal-weighted indexes. Okay, and then secondly, be familiar with various security indexes and their potential weaknesses. So that's the key area to cover. Now, starting first with the first LOS, describe a security market index. What is a security market index? A security market index is used to represent the performance of an asset class or security market as a whole, or a segment of a market. So basically, a security market index is a tool we use to measure the performance of an asset class, the security market as a whole, or a segment of security market. All right, these are the examples here. As you can see, S&P 50, 500, Dow Jones Industrial Average, Nasdaq Composite, S&P 100, Russell 1000, and all these are the examples of your security market indices. Okay, now, next concept in this reading are constituent securities. Let's say I'm talking about Pakistan Stock Exchange. There are thousands of firms in Pakistan Stock Exchange, and if I want to construct a security market index, I have to select certain stocks, let's say A, B, C, D, and E. I have selected these 5 stocks to be included in my index, and using these 5 stocks, I will track the performance of the whole market, let's say. So these 5 stocks represent the constituent securities. Over the period of time, there will be change in index, and this will help me to calculate index return. How do we calculate index return? That is the subject of our subsequent readings. Here we just needed to learn what is the security market index that is created out of the selected constituent securities, and movement in the index will help us calculate returns. Let us move on to the next reading, and that will help us understand the idea of return. Next LOS, calculate and interpret the value, price return, and total return of an index. Now, we have just taken an example. Let's say these are the 3 securities, the constituent securities in an index. Now, with the help of this example, we'll try to understand what do we mean by price index, and how do we calculate the price return and the total return. So, index return, how well the securities have performed. An index return may be calculated using the price index or the return index. Let us see what's the price index. Look at, these are the constituent securities, A, B, C, D, E, F, and G, H, I. An analyst gathers the following information for a price-weighted index comprised of securities A, B, C, D, E, F, and G, H, I. These are the prices of securities 25, 35, and 15. If you add all these, the total of these securities 25, 35, and 15 is 75. Right? We're talking about the price index now. At the end of the period, prices have changed. This stock has gone up by $2 or pound 2. It has fallen by pound 10, and it has gone up by pound 1. So the total sum of prices 27, 25, and 16 gives you 68. Now, what has happened over the period? The sum of prices at the start was 75. The end period prices are 68. The difference between these two is 7. 7 reduction based upon the original total prices will give you the overall return, which is negative. It's 9.333. So this is the price index. What we do, we take the beginning prices, we add up the ending price and see the difference, whether the sum of prices have gone up or gone down. So this will give us the overall return, the price return on this index. So this is the price return. Mind it, we have just taken the prices, the differences in the total prices in opening and closing. So of course, when the prices of stock goes up, it's the capital gain for the investor. When they go down, it's a loss. So basically here, there is a negative return. Prices have fallen in aggregate by $7. So there is basically a negative return of 9.33. This is called price return. Now we need to consider here, in this index, there were 3 stocks and each had a weight equal to the price it had. So the weight of ABC is 25 upon 75. The weight of DEF is 35 by 75. So the weight basically is represented by the prices, right? And ending period, since prices have changed, so weights have changed as well, right? Now there is another deviation or variation of this price index where we take equal weights. Now there are 3 securities, Able, Baker and Charlie. These are the beginning prices and these are the ending prices. What we are required to do, we need to calculate the price return. Now this is different. Now these are equal weights. Previously what we did, we summed up all the prices, 60, and we summed up all the ending prices and the difference was our return. But this case, we have to consider each security equally. So what is the right way of doing it? See what is the difference between the prices of Able. The increase is 2 euros and 2 euros, it's what percentage of the original price? 2 by 10, it's 20%, right? What about Baker? You lost 1 euros based upon the original price, negative 1 by 20 multiplied by 100 will give you negative 5%, right? And Charlie, there is no change. No change in price is 0 upon 30 times 100. So it means 0. So adding all these 20, negative 5 plus 0 gives you positive 15%. And then dividing it with 3 gives you 5%. This is equal weighted. What I did, I calculated the returns of individual stocks and then returns are then averaged. Now, each stock had equal weight. That's why it's called equal weighted, and this is the price return. I've just considered the changes in price over the period. But previously, here the weight was different. The beginning weight was different because the beginning prices were different and then the ending prices were different. So the weight was changed over the period. It was a price return index, but it was price weighted. Here it was equal weighted, right? So just take change in the prices and then take the percentage change and take the average at the end. It will give you the equal weighted index price return at the end of the period. All right. What if the securities in your index, they also generate some returns, interest, dividend income? So if you incorporate the changes in prices together with the incomes generated by these securities, the return that you will now calculate is called now the total return, the increase in price or decrease in price as well as the income generated by these securities, right? So what we calculated here was just the equal weighted price return, that was 5%. Now let us do this in case of we need to calculate the total return. Okay. An analyst gathers the following information for an equal weighted index where the weightage is given equal to all the stocks. We will use the same dynamics. We will calculate the return for each security separately and all the returns then will be averaged. But this time, not only we have to take the changes in prices, we will also have to consider the dividends earned over the period. Okay, so in order to calculate the equal weighted. Okay, now, Able has generated $2 of return, 2 euros in the form of price appreciation, and it has generated a dividend of 0.75 euros. So combining these two gives you a total return of 2.75 euros. Divided by the initial investment in this stock or initial price to be 10. So 2.75 upon 10 gives you 27.5. For Baker, the price went down by 1 euro, but there was a dividend. So overall, the net change or the overall return on this asset, -1 plus 1 is simply basically 0 upon 20, so it's going to be 0. Mind the word, it's equal weighted, and we are calculating the total return. Total return means the change in price as well as the dividend or interest earned on that particular security. For Charlie, the price stayed the same, but there is a return on the form of dividend. So it's 2 upon the original price 30. So 2 by 30 times 100 gives you 6.667%. Now if you add all these and divide with 3, it will give you 11.39%. So that is the total return index. 11.4 equal weighted, where we just took the returns and then simply divided it with 3, because there were 3 securities in the index. All right, moving on to our next reading. Describe the choices and issues in index construction and management. What are the issues we face in construction and management of an index? What's an index? We just discussed a little while ago. Index simply is a representation of performance of an asset class, security market, or a segment of a market. And the change in the index value will represent the return over the period. So, what are the choices we have? What are the issues we will face in the management of an index? Index providers must make several decisions. First, what is the target market? What do we want to measure? Equity, bonds, or other fixed income securities specifically defined. So first we need to define the target market that we intend to measure. Next, once decided that we would be selecting certain securities from, let's say, health sector. We want to construct an index for health sector. Decided that is my target market, and out of this sector, let's say there are 25 firms, and out of these I just select 5. So these will be my constituent securities. So 5 out of these 25, these will represent my constituent securities, and based upon the performance of these 5s, I can get the overall performance of this particular sector. So which securities from the target market should be included? These 5. Now these 5 securities have been selected. How would I weight my index? Would it be the return weighted? Would it be price weighted? How the securities would be weighted? Price weighted, market capitalization weighted. What should be the weighted use? Weightings. Then during the period, maybe there might be some changes. Let's say if I have selected equal weighted, let's say I have selected 5 securities A, B, C, D, and E, and my weightage is equal weighted, for example. What if during the period the certain securities have undergone change in prices? I have to keep the balance. Let's say $1,000 is the investment in each stock, for example. If the price change, then I may have to change the weight of individual security A or B or C. So the change in price may require rebalancing of these securities in the index. If I need to rebalance, what would be the frequency? Normally it is done every quarter. Would I do it on monthly, yearly basis or biannually? Normally it is done on quarterly basis. So frequency of rebalancing must be decided. This is what the index providers must do. Then, how frequently we will examine the index constituent securities? When should the selection and weighting of securities be re-examined? So these are the issues that the index providers must address to before they select a certain, they decide to make a certain index to track a performance of certain market. Now, my target market could be a very broad one, probably all the stocks in the United States, or it could be a very narrow market, just like this. The index was just tracking the performance of health sector in my country. So it could be a very broad market, it could be a narrow market, a segment of the market. What would be the basis of classification? Will it be the regional index for a particular region? Or will it be a particular sector, just like the example I gave you that I want to track the performance of health sector. So these are the questions, these are the issues that the index providers must address to. Right? Now, next LOS says, compare the different weighting methods used in index construction. Basically, there are 5 types of weightings: price weighted, equal weighted, market cap weighted, float adjusted, market capitalized weighted, and then fundamental weighted. I have just given this in a tabulated form so that you can make a better comparison. You can see them comparatively. So first, let's discuss the price weighted. The very first example we did, we would do all these. All of these are a part of our practice session from the question, so they will be covered. So that's why when I say theory plays hardly 20 to 30% of your preparation, the rest of preparation comes from practicing the questions. Whatever might be missed, whatever might be lagging, will be covered well in the question practice. So in price weighted, we simply take arithmetic means of prices. That was the very first example we did. That was price weighted. Let me take you back to the example. See, this was the price weighted. What we did was simply added up these prices, right? And then we added up the ending prices. The difference between the prices will reveal either the improvement or deterioration in the index, positive returns or negative returns. So this is the first categorization we have here, price weighted. So the method is arithmetic means of prices, opening and closing. The difference will reveal the gain or loss over the period. Advantage, it is simple. Disadvantage is that the stock that has a high price will have a high weight. Let's go back to the example here. Now this stock has a price of 35, and you know what is its weight in this composition? So it's going to be, I think it was 75, 25, 35 and 15, 75. So 35 by 75, this single stock has a weight of 46.66%. See? So change in this stock's price will have a larger impact upon the index return. So that's the drawback. High price will have high weight, and resultantly the performance will be over or understated because of a single stock that is highly priced. And there are some examples as well. Dow Jones Industrial Average, based upon 30 largest US stocks, it is the price weighted index. Then Nikkei Dow Jones Stock Average, it contains about 225 stocks if I remember correctly. It's a price weighted index. The problem with this method is that over the period, the firm may repurchase its own stock. The firm may issue more stock dividend, or maybe there might be some stock splits or reverse split. Split means a single stock may be split into 5 smaller stocks, or in reverse split, maybe 10 smaller stock might be combined to make a single large denominated or large power value stock. So this would affect price, because whenever there is a stock split, for example, let's say currently a stock that is trading at $60, the company decides to split the stock in 10 equal parts. That's 10 for 1. 10 new stocks for 1 existing stock. What will happen? The market price will immediately fall as soon as the stock is split and it is known in the market. It will fall to $6. Right? Since the price has changed, so we need to make some adjustment in the denominator so as to keep our index same. For example, let's say before the split, the index was 40. It was calculated this way: 120 divided by 4. It was 30. I'm just taking another number totally different from what I was telling. Now let's say a firm has decided to split its stock. This stock split has now resulted in a numerator of 90, for example. Now, what should the denominator be? Let the denominator be X. We cannot change the value of the index, which was 30. Because of the stock split, the value of the index will stay 30. Before the split and after the split, it has to stay 30. Now, what should the denominator be? Since the price total has now fallen to 90, what should be the new denominator? Make X the subject of the equation. X is equal to 90 by 30. Now, the denominator will be 3. So, it's going to be 90 by 3. So, in order to give you the index value of 30. So, index value is kept same. You have to change when the prices change. They will change the numerator. So, you have to adjust your denominator in a way that the total index value stays the same. So, that is the problem with the price weighted index, that you may have to change the denominator whenever there is stock repurchase, stock split, or any stock dividend given by the firm. So, that's the price weighted. Next is the equal weighted. In equal weighted, arithmetic mean of the equal dollar invested, like this was the example. The second one was equal weighted, this one. Equal weighted means that every stock is given the same weight. So, when the returns are earned, returns are simply taken as an arithmetic average of the returns, right? So, this is what you call the equal weighted, where each stock or each constituent security is given the same weight. Arithmetic mean of equal dollar invested. It is simple. But what is the problem with this method, this weighting, is that you have to make periodic readjustments. Other drawback of this method is that small cap will have more weight than should be, and then large cap will have less weight. That's the problem with this weighting, that the small cap, since each have been given the equal value, equal dollar amount, so those stock that have small capitalization, they will be overweight. They will carry more weight in the index. Since we have to, let's say we have to invest $1,000 in each stock, for example. So since the amount is the same, the small cap, which should have less value, because of the equal weightage, it will be overvalued or overweighted. And the stock, large cap stock, we should have more weight, because of the equal dollar investment, it will be underweighted. That is the drawback of equal weighted method. Then the examples we have, the example of this type of weighting index are value line composite and average, FT ordinary share index. So these are few indexes that take equal weighted as the basis of index construction. Then we have, this is the most widely used weighting method for index construction, market capitalization weighted. We use the market capitalization. What is market capitalization? The share price, let's say $50 multiplied by the total shares outstanding. So 1,000 times 50, so it's $50,000. This $50,000 is the market capitalization of stock A, B, C. This way, the index is constructed based upon the market cap of the constituent securities. What is the advantage? If there is any stock split, any stock dividend, stock repurchase, no adjustment is required. What is the drawback then? Overvalued stock will have larger market cap. So such stock will have heavy weight. The stock that is overvalued will have larger market cap, so it will have more weight than it should. And the stock that is undervalued, since it will have low market cap, so it will have less weight than it should. That's the drawback. So we have two examples of this type of weighted index, that's CAC 40, that is the French index, and S&P 500. Then we have another categorization of weightings, float adjusted market capitalization weighted. What is market capitalization? Let's say this pie represents the total shares outstanding. Out of these, 30% shares are held by institutional investors, government agencies, and they are not willing to sell these shares, and these shares are technically not in movement. They are not being bought and sold. The investors are holding on to their investments. The remaining 70% is in the market, which is actively available for the investors. This is called float, right? shares that are available to investing public, which will change hands. So since these 30% shares are technically blocked, they are not being traded actively in the market, so they should not be included in the calculation of index composition or index value. So we will take only those shares that are in the public domain or available to the investing public. Right? These stocks maybe are held by the investors who don't want to sell, maybe they are held by the governments, institutional investors, you're holding on to their investments. So this is what is used as a basis of float adjusted market capitalization weighted index. So what we do in this type of index, we use weights based on the market capitalization based upon float. 70% of the shares that are in the market, there are 100% shares outstanding, but out of this only 70% are in the market that are being actively traded, available for the investing public. So we will multiply the current market price with only the shares that are in the market. This will give us what you call the float adjusted market capitalization. Again, the benefit is the same, no adjustment for split stock dividend because the price will automatically adjust. Free float or market capital weighted, they require no adjustment of stock split because if there is a stock split, automatically the price will change. And eventually there is no need to, market capitalization will stay the same. Number of shares will go up, the price will fall, but the capitalization stays the same. That's the advantage. What's the drawback? Overvalued stock, again the same, is given more weight than it should, and the undervalued stock is given less weight. S&P 500 is an example of float adjusted market capitalization. Basically, S&P is market cap weight as well as float adjusted. So that's why it is in the both categories. It is basically float adjusted, that's why it's here, and it is also market cap based, so that's why it's in the both categories. I should have put it here only so as to make it clearer, not to confuse. Finally, the last weighting method is fundamental weighting. In this methodology, we take earnings, fundamental. These are the fundamentals because the share price is dependent upon these stimulants. They affect the share price. Earnings directly affect your share price. Gordon growth model, dividend discount model. So these affect your share price. So rather than taking directly the market share price, which we will take in the long run, but we weight this price based upon the fundamentals that determine the share price. The problem with this index is that it suffers from value tilt. What basically is value tilt? Value tilt means we may have overweighted certain stocks A, B, C. We have given these stocks more weight. Why more weight? Because they have higher earnings or higher dividends. So we are more leaning towards the firms with higher fundamentals. This is called value tilt. Overweighting firms with higher earnings or higher dividends or higher cash flows. So our tilt, our leaning is towards the value that we assign based upon our fundamentals. Overweighs firm with high value based input, earnings yield, etc. So there are, this is the index specifically based upon fundamental weighting, FTSE-RAFI index. Then we have our reading 5. It says calculate. Now we will calculate these, what we have discussed, so that to enhance our understanding. Calculate and analyze the value and return of an index given its weighting methods. Okay. What is the price weighted index of the following 3 stocks? Price weighted index. Price weighted index means we just have to add up the price. What's the index number? You simply add up the price 50, 35 and 110. 50, 35 and 110 and divide it with 3. That is 65. This is price weighted, right? You simply added the price and divided with 3. So that gives you the price weighted index number 65. Next. So this was price weightings. Next, market capitalization weightings. Now gentlemen, attention. The table below lists information on price per share and shares outstanding for 3 companies: Layer, or is it Layer Enterprises, Curlew Incorporated and Mao Limited. So the price per share at the start was 15.45.90. These were the share outstanding at the beginning. The prices are now different from 15 to 10, 45 to 60 and 90 to 110. Now, and these are the share outstanding are the same. We now need to calculate what? Assume that at the beginning of the year, the value of the market index was 100. The 1 year return on the market cap weighted index is closest to. What you should do first is to calculate the total market cap at the start, total market cap at the end, and see the difference. So what you're going to straightforward, 15 times 10,000 plus 45 times 5,000 plus 90 times 500, it gives you a total of 420. This is the opening market cap. Closing market cap 10 times 10,000 plus 60 times 5,000 plus 110 times 500. It gives you, I miscalculated, 455. Okay. So what is the change? 455 upon 420 multiplied by 100. Now the index, since 455 is the closing market cap, 420 was the opening market cap, taking it as the base, multiplying it with 100 will give you 108.33. So if the index base was 100, now it's 108.33. So the return, gentlemen, is 8.33%, and that is right here. So what you do, you calculate the closing market cap, opening market cap, the difference between the capitalization divided by the original. You can calculate directly by taking the difference between these two, 455 less 420, and simply dividing 35, that's the difference, $35,000, divided with the original market cap, 35 by 420 will give you the straight result of 8.33%. This is your market capitalization weighting based return. Then we have equal weightings. Now this is important. In equal weighting, this is my suggested method. Rather than just assuming a single amount, equal amount invested in all these stocks, my recommended approach is to take the return in all these stocks separately. Once you get the result, divide it with 4. You apply this approach, it will work in every question. You will do it. You will see it when we start doing questions. Right? Equally weighted index, if you need to calculate the index value or the return, you simply need to calculate the return on individual stocks and simply divide all the return sum with 4, and you will get it. So here we go. Look at this now. There is no return technically. 5 less 5, 0 upon 100, so basically it's 0%. Right? Initial price 10, closing 12.5, so the increase is 2.5. 2.5 times 10 times 100, that is 25%. Here the increase is 7.5 and 10, the increase is 2.5. 2.5 is what percentage of 7.5? 2.5 upon 7.5 times 100 gives you 33.33%. And lastly, the change 5 to 8 is 3. 3 upon 5 times 100 gives you 60%. Right? So despite the first stock W has 0 return, you will add all these. 0 won't have any effect on computations. 25 plus 33.333 plus 60 divided with 4, what you get is 29.58. If the initial value of the index was 100, this return 29.58 will increase it by this, so the closing index value will be 129.58, and that perfectly matches with the result given here. Okay, now I have added these two LOSs because they were comparatively shorter. Describe rebalancing and reconstitution of an index. Let's discuss this LOS first. What is rebalancing? Let's say you have 3 securities A, B, C. Rebalancing refers to adjusting the weight of these securities in your portfolio to the targeted weights, because the price keep on changing. A, B might go up and down, prices are changing. So in order to give them the equal weights, we have given them the equal weights, 33.33 in the portfolio. But because of changes in prices, the overall composition of our portfolio or the index may change, so we may have to rebalance. stocks that have gone up in value, in order to keep their balance equal in the overall portfolio, will take some cash out and put in that stock that has decreased in value, in order to keep your total investment same and the weight as per the original assigned weights to it. This is called rebalancing. Rebalancing means adjusting the weights of securities in your portfolio to their original targeted weights. We need to keep these weights same. So if there are changes in prices in A, B, and C, we may have to sell and buy in order to keep the total proportion between these three stocks same, 1/3, 1/3, 1/3. Any point in time, your investment in each stock should be 1/3 of the total investment. So that may change over the period. So we may have to rebalance it in order to keep the weight same. This is called rebalancing, right? Makes sense? What is reconstitution? Let's say your index has 10 different securities, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10, let's say. Reconstitution means that certain securities which do not fit in the index. Why? Because maybe they have lost the criteria which we select or which we use to select a particular security. Maybe the company has been delisted. Maybe this company has gone bankrupt. Or this firm might have merged with another firm. So when such a change occurs, delisting, bankruptcy, mergers, so such securities required to be excluded and new that meet the criteria needs to be added. This is called reconstitution. Changing the composition of your index so as to keep it up to the objective that you have set at the start of the index construction. So we may add or remove certain securities from the index. This is called reconstitution. One very important point that we must discuss now. I'm sure all of you are following. Tesla Motors, its market capitalization today has reached $500 billion. Elon Musk now is the second richest person in the world. He holds a lot of options in Tesla, and these options are now valued in billions of dollars. Why I'm saying this? Tesla is going to be added in S&P 500 by December 2021. So this index will be reconstituted. Tesla would be added in that index. Now it has resulted in increase in Tesla share price. Why? Because since Tesla will be added in the index, the portfolio managers, they have started purchasing Tesla stock in order to track the particular S&P 500. Right? So the stock that is to be added in an index, its price normally goes up because the portfolio manager, they rush after the stock and put them in their portfolio. And the stock that is going to be removed, its price will tend to fall because managers will also sell them. So that's the reason. Now next, index have several uses. Let's quickly go through these. Index have several uses, and this was the second LOS. Describe the uses of security market indexes or indices. Index is used to gauge the market sentiment, reflect the market sentiment. How do the investors are behaving? Index will tell us. If the index is increasing, that there is net buying sentiment. If the index is falling, it means there is net sell. Or the economy is in downturn. Investors are offloading their positions. So it reflects the market sentiment. Then second, it's the benchmark of a manager's performance. For example, we'll study the style stock later, style investment later, or style index. Benchmark of manager's performance. Benchmark should be consistent with the manager's style. Let's say our manager has invested in health sector, right? His portfolio has generated 25% return, whereas health sector's index indicates a return of 35%. Now, this indicates that our manager didn't perform well at investment management. The index has gone up by 35%, whereas his portfolio has generated a return of 25%. So it's a benchmark with which we can track the performance of a particular portfolio manager. Next. Indices are used as a proxies for measuring and modeling returns, because index show the overall sentiment of the market, so we can use index as a benchmark for our modeling. Measure of beta, we will discuss this in our subsequent readings. Index is also used as a proxy for measuring beta. What is beta? It's a measure of risk of the system. It's called the measure of systematic risk. It also helps us to measure risk-adjusted return. How? It's coming in our subsequent readings. Index may also be used to model portfolio for index funds, or let's say, take the example of auto industry. There is an index specifically tracking auto industry. So I can construct a portfolio that tracks this auto industry index. We can model our portfolio in the same composition as we have the stocks in the auto sector. Right? Same time, it could be used model portfolio proxies for assets classes in asset allocation model. We'll discuss in our subsequent readings. So these are the multiple uses of indices. Next, reading 8. Describe types of equity indexes. These are 5 different types of index. First is broad market index. As the name suggests, that these indexes cover a larger part of market, not whole, but most of it. So it is defined as the index that covers more than 90% of the market is called as broad index. There is an example, Wilshire 5000. This is the name of the index. It contains 6,000 securities in the index. So you can say it's a broad index that contains lots of securities. Then we have multi-market index. As the name suggests, this index contains many markets in different geographical regions, in many countries probably. It could be based upon economic development, also called the emerging market indices. It could be an index for a particular region, like North America. Or it could be an index for the entire world, like MSCI World Index. Then we have multi-market index with fundamental weighting. Fundamental weighting, same that we discussed a little while ago. But in this case, rather than having earnings, dividends, and free cash flows, we will use some fundamentals like GDP. Right? Then we have sector index. As the name suggests, these are for specific sectors as we were discussing: auto sector, healthcare, financial, consumer goods, etc. And this is style index that I was talking about a little while ago. Style index, they measure the return to market based upon the value or growth strategy. These we have discussed already. Certain stocks are classified as value stocks. Why? Because they have right now lower price earning multiples, but they have high dividend yields. Compared with the growth stock, they tend to have higher price earning multiples, but lower dividend yields. So indices that are based upon these measures, values or growth stocks, they are called style indexes. Then we have describe types of fixed income securities. Fixed income securities means bonds, government bonds, corporation bonds. The specific feature related to fixed income securities is that there is great variation in these types of. Some have very high coupon rate, some are zero rated, some might be AAA rated, some might be ungraded, some may have maturities up to 5 years, some may be up to 30 years. So there is a great variation in fixed income securities with regard to coupons, ratings, maturities. So consequently, there are many wide variety of fixed income securities indices. In fact, fixed income market is much larger than your equity market. So basically you have large universe of fixed income securities from which you need to construct your index. Right? Large, much more. The market of fixed income securities is much broader than the universe of stocks. The problem is that stocks are forever. but bonds have a maturity date. So there will be frequent reconstitution of fixed income security indexes. So there will be high turnover, more reconstitution. So since this reconstitution would result in that certain portfolio managers, an active portfolio manager A, for example, he is tracking a certain index. So the reconstitution or changes in the index may result that he will have to buy or sell certain fixed income securities, and these securities, when bought and sold, will involve transaction cost. That's why the cost of managing fixed income securities which track a certain index could be significantly high. Furthermore, the fixed income securities are mostly dealer markets dominated by dealers who buy and sell for their own inventory, and they sell bid and ask price. Such markets are illiquid because the securities are not as liquid as the equity markets are. So that's the problem with it. Then finally, we have the second last LOS. Describe indices representing alternative investment. What is alternative investment? Other than equity and bonds, we have alternative investments like different commodities, investment in real estate, investment in hedge funds. These are your alternative investments. We'll discuss these in our subsequent readings. These are called your alternative assets. So there are certain alternative investment indices as well. Commodity indexes, as you see, different commodities like energy, metal, precious metals, industrial metals, livestock, grains. So indices related to commodities could be weighted index, could be equal weighted index, could be market value index based, or could be based upon the value of the output base. So commodity indexes can be of many types, like CRB index is one good example. S&P GCSI is also an example of commodity index. An important point to note for commodity indexes is that the price of commodity indices, the value, is dependent upon the future contracts, not the actual commodity price, the actual spot prices of the commodities. Then we have real estate indices. These indices track the properties values. Normally property is quite an illiquid investment, but if you want to make investment, you want to diversify, so instead of investing in property directly, you can invest in real estate investment trust. They are traded like normal shares, so they are quite liquid. So this is another option for diversifying your assets. Then we have fund indices. Fund indices mean the indices related to hedge funds. Hedge fund, what are hedge funds? Hedge funds are loosely regulated investment vehicles. There is no reporting for these funds. These funds invest in highly leveraged investments, or investments that are highly leveraged, involve a lot of loans, borrowed money. They invest in derivative contracts. So most of the hedge funds are equally weighted. Hedge fund indexes are mostly equally weighted. There are certain issues with hedge fund indices. First of all, they are unregulated. They are not required to report. There is poor reporting in hedge fund. Let's say if you have constructed a hedge fund index and there are maybe 4 hedge funds that are included in your index, since the reporting is not mandatory, some of these who have not performed well, they might not report their returns. Hence, only those funds will report they have generated good returns. Those who have generated bad returns, they don't want to disclose their bad returns, otherwise that will reflect badly on their performance. So this is the reason in fund indices there is an upward bias. Means only those numbers will be appearing, those hedge fund numbers that have generated better returns, thereby showing an upward bias. Funds that have generated bad returns, they will not report. So because they are not regulated, they have to voluntarily disclose their results, and only those results will be reported that are good. So what you have in the index are good results. That's why the fund index tends to be upward biased. Finally, compare types of securities and market indices. We just need to go through these and read them for your understanding. What are the famous indices, their composition, constituent securities, and weighting methods, and just go through this a couple of times should be sufficient. So that completes your reading security market indices. Now we'll do questions.